They check the tax return near the end of the year and nothing dramatic happened all year. Then one unfamiliar line quietly adds $2,700 for having no private health cover at all. By the end of this video, you'll know the exact income point where skipping cover stops saving money and starts costing more than the policy itself would have. We pulled these numbers straight from the ATO's 2026-27 Medicare Levy Surcharge thresholds and privatehealth.gov.o, not a rumor, not last year's rates, not a guess from a comparison site. Quick note before we go further, this is general information only, not personal advice. Check a licensed professional for how it actually applies to your household. We were healthy. We rarely saw a doctor beyond an annual checkup, and neither of us had ever been admitted to hospital. So the logic felt obvious. Why pay a monthly premium for hospital cover we might never use? We figured we'd rather hold that cash ourselves and self-insure against the small chance something happened. Here's the cleaner way to see it: skipping the premium is not free. The tax office already built a price into that exact choice. It's called the Medicare Levy Surcharge. Most of us already pay the ordinary 2% Medicare levy, which funds the public health system for almost everyone. The surcharge is a separate additional charge on top of that. The names are close enough to blur together, and that's exactly how households end up assuming they're already covered by paying the ordinary levy. They're not the same charge at all. For 2026-27, a single person earning $105,000 or less pays no surcharge at all. For a family or couple, that base threshold sits higher at $210,000. The rule exists to nudge higher-income households toward private hospital cover, so the public system carries a little less elective pressure. It's a policy lever, not a punishment for being healthy. The theory is straightforward. If enough higher-income households who can afford it choose private cover, that frees up room in the public system for people who need it most, wherever they live. None of this means self-insuring is a bad instinct. For households under the threshold, it's still completely valid. It only becomes a cost once your income crosses that line. Above the base threshold, the rate climbs in 3 steps: 1%, then 1.25%, then 1.5% once you reach the top tier. Honestly, this part confused us for a week. We assumed the surcharge was one flat number, not a rate that keeps climbing the further past the threshold your income sits. Here's the trap. Unlike income tax brackets, the surcharge rate applies to your whole income once you're over the line, not just the slice above the threshold. To stop the surcharge, you need approved private hospital cover, not just any health-related product. That distinction is exactly where a lot of households get caught out. For couples and families, the cover generally needs to sit under the household, covering every person who counts for the surcharge, not just the main income earner named on the policy. Extras only cover dental, physio, optical does not stop the surcharge on its own, even though it genuinely feels like having health insurance when you're paying for it monthly. The policy also has to come from a registered Australian health insurer. A cheap international-only or non-registered product can look like cover without actually stopping the surcharge. Families above the family threshold need every dependent who counts for the surcharge listed on the policy. Leaving even one name off can leave the surcharge switched on for everyone. That family threshold isn't fixed either. It rises by $1,500 for every dependent child after the first, so a bigger household gets a bit more breathing room before the surcharge applies. Suspending cover for a long overseas trip feels harmless, but the surcharge still runs day by day while cover is paused, a detail that quietly surprised us too. Buy cover partway through the year and the exemption is usually partial too. You still owe the surcharge for the uncovered days, not the whole 12 months, but not zero either. Run the maths across real incomes and the pattern gets sharp fast. At the bottom, a single person on $120,000 owes $1,200 a year for staying uncovered. Push that same single income up to $150,000 and it's $1,875. Push it to $180,000, right at the top tier, and it becomes that $2,700 figure from the opening. That's the number that started this whole video for us, a tax bill bigger than we expected, for a choice we genuinely thought was saving us money. So picture one household plugging in their own figures. A single income of $180,000 sits well past the base threshold, lands in the top tier, and produces exactly that $2,700 bill. Compare that $2,700 surcharge to an illustrative basic hospital premium for that same income, and cover usually comes out cheaper than the tax alone at that level. That premium band moves with age, state, fund, and rebate tier, so treat it as a planning range to test against. The real number only shows up once you request an actual quote. One honest caveat: the policy's excess still has to sit at or under $750 for singles or $1,500 for families to count, and that excess is a real cash hit if you actually claim. The opposite mistake is overbuying. Gold extras and packages you'll never use can quietly erase the exact saving that made choosing cover worthwhile in the first place. That doesn't mean extras cover is pointless. Dental and optical can genuinely save money if you use them. It just means extras alone were never going to stop the tax bill. For a family on $280,000, the gap widens further. The surcharge alone often sits above the cost of a genuinely compliant basic hospital product for that household. Even after adding a realistic excess risk on top of the premium, the surcharge still tends to come out higher for that family. Cover isn't free, but the tax genuinely isn't either. The picture looks different again for a single-income family sitting closer to the base threshold. The gap between the surcharge and the premium can be much narrower, so it's worth checking every year rather than assuming last year's answer still holds. Combine two solid incomes under one roof and that family threshold arrives faster than either partner expects on their own. Worth running the combined figure, not just each person's individual pay. For households closer to retirement, reportable super contributions can push income for surcharge purposes higher than expected, worth checking well before you assume you're safely under the threshold. The same threshold check matters the moment a second income starts. A part-time return to work, a side business, or a partner's promotion can move a household from comfortably under to just over. So pause on this one. Does your household actually know which side of that threshold you're sitting on right now, or are you guessing the same way we were? Here's where we slow down, because the number that actually matters is not your take-home pay, it's your income for surcharge purposes, and that's wider than most households expect. The ATO adds items like reportable fringe benefits and reportable super contributions on top of taxable income. A safe dual income can cross the family threshold without anyone noticing until tax time. The practical fix is small. Check your income statement for reportable fringe benefits and reportable super, and add them to your taxable income before you compare against the threshold. That same income figure also decides your private health insurance rebate. Get the definition right once, and it settles two separate questions instead of just one. The thresholds and rates are the same whether you're in a capital city or a regional town. The only local variable worth checking is which private hospitals sit within reach of a compliant policy. One separate caution: delaying hospital cover for years can add lifetime health cover loading later, a different rule from the surcharge, but worth checking before you decide to wait indefinitely. Thresholds move most years, and so does income. A household that was safely under last year can drift over this year without a single deliberate decision being made. Always check the current year's table directly on the ATO or private2health.gov.o pages before you rely on a figure. Thresholds from an older year will not match this year's bill. These are the traps that catch healthy, careful households, including us, because none of them show up on a payslip. They only show up once the tax return arrives. If it helps, we personally made two of these. We assumed taxable income was the whole story, and we nearly let a suspended cover trip run longer than it should have. None of this means you got it wrong on purpose. It means the number belongs in the decision from the start, not in the surprise column at tax time. Every household we've talked to about this got there eventually. The only difference is whether they worked it out before tax time or found out the hard way like we did. Here's the practical version, 6 steps you can actually run tonight, using your own numbers instead of guessing the way we did for years. None of these steps needs a professional on day one. They're the same order the ATO's own guidance follows, just translated into plain English and one evening's worth of effort. First, calculate your income for surcharge purposes using the ATO's income tests calculator. Second, pick the right table, single or family, for your household. Third, read your tier rate off the table honestly, even if it stings. Fourth, multiply that rate by your income. That's your surcharge if you stay uncovered all year. Fifth, get a real quote for a compliant hospital product with an excess under the limit. Sixth, decide your purpose, avoiding the surcharge only or wanting genuine elective and specialist timing too. Say your income for surcharge purposes lands at $175,000. That's Tier 2. So $175,000 times 1.25% comes to $2,187.50 a year if you stay uncovered. Line that up against a real compliant hospital quote, and the comparison stops being theoretical. It becomes one number against another number, both belonging to your own household. If the two numbers land close together, that's a genuinely fair call either way. The surcharge test tells you the tax comparison, not whether cover suits your household beyond that. That's the whole test. Know your income, know your tier, get one real quote, and compare it honestly to the tax bill before assuming self-insuring still wins. You don't need to solve every year of this decision tonight. You only need this year's honest number, sitting right next to this year's honest quote. Write the 3 numbers down somewhere you'll actually see them again, your MLS income, your tier, and your best quote, so next year's check takes minutes, not guesswork. Treat it the same way you'd treat any other annual check, a few minutes each tax time, and you'll never be surprised by that line item again. Once you can see exactly where you sit against the threshold, you're no longer guessing which choice is smarter, you're choosing it on purpose with your own real numbers. If this helped map your thinking, subscribe. We put out one of these guides every week.